Hi, everyone. I hope you're really well. I'm Pamela Hastings and welcome you to another Barometer webcast. During this webcast, we will provide a review of current and market economic conditions, and we have invited one of our leading portfolio analysts, Brian McNichol, to join David Burrows in conversation and to discuss the Q2 earnings season. As always, I encourage questions from participants, so please email me at phastings@barometercapital.ca, or you can message me in the chat. We will address your questions at the end of this webcast. Thanks again for joining us this Wednesday afternoon, and I will turn the conversation over to our President and Chief Investment Strategist, David Burrows. Good afternoon, David. I hear we have quite the show this afternoon.
Good afternoon, Pam. Thanks so much for doing this, and I certainly want to welcome Brian on the call. Welcome to the heart of summer. It's August the 5th. The summer is marching through. It is an unusual one, that is for sure. And we're just trying to work our way through what has been a very unorthodox period in the economy and in the market, and certainly from a social standpoint. Everybody is focused on the news. And focused on, I think, their financial situations, given what's going on. Everybody feels a little bit mortal, and certainly, you know, it's not lost on us. We've been working very hard in the background every day on the portfolios, just to make sure that the portfolios stay aligned with what is happening in the market, as opposed to what we think should be happening. Market has been continuing to work its way higher, and we've talked about the fact that we do believe we're in a structural bull market. We've been using the strategy that we have always used. We're running our bottom-up security selection to try and find companies that are good getting better, that are benefiting in the current environment, where we can see it in the numbers and the price performance of the shares. We're running our top-down work to try to focus on areas of the market that are seeing net inflows, parts of the market that people care about. And try to avoid the ones that there seem to be outflows in that are not well suited to the current environment, really to pick our spots and be focused in what we consider to be market leadership. We are continuing to ratchet the stops up underneath our existing positions, but some of our positions just want to refuse to quit. The strength remains the strength, the laggards remain the laggards, and there hasn't been a lot of turnover. Just to kind of walk through it, we've been rallying since we saw the low in March. We briefly dipped below this long-term trend line in the S&P. This goes back to 2013, when we took out the highs from 2000 and started a new structural bull market. Last structural bull market lasted 18 years. And so some can say that we are only 6 or 7 years into what could be 15 or 18 years of upside over time. And certainly there's some big interruptions, like there were in the late 1990s, in the Asian currency crisis, or the crash in 1987, or the recession in 1990-91. We went through a very significant waterfall decline, most significant in history, and the market's been fighting its way back. It has been a combination on one side of some very, very strong companies within industries with a structural tailwind, and many of those are companies that we all know. And some ancillary companies within the same themes that are benefiting. And on the other side, there are some companies that really are struggling, like the airlines and the travel companies and the companies in the hospitality business, where they have been really negatively impacted. You've got, on one side, very supportive Fed and central banks around the world who are making sure there's lots of liquidity. And you've got governments working at using fiscal stimulus to put activity into the economy. And on the other side, we have some really, really negative human situations from a healthcare perspective in the COVID. So as we said, the market continues to work its way higher. We took out the highs from early June in the S&P, and we are just busy closing this opening gap that started the decline in February, which is certainly a positive, getting back towards highs in the market. Now that's the S&P 500. And the S&P 500 doesn't necessarily reflect, you know, Main Street business. These are largely global businesses, many in very specific verticals. some of which are really benefiting, some really big companies are really benefiting. The Dow is not been performing quite as well. We're still struggling to get back to that June high, which we then consolidated following, although the last week, it's worked its way a little higher. We're still sitting well below the gap down from the beginning of February. A week ago, we highlighted the fact that our short-term indicators and long-term indicators were a little bit sloppy. So the market's rally has been narrowing. So fewer companies carrying the day, more focus in the leading companies. And some of the companies that are not the leading companies have been lagging and seeing money flow out. We were seeing that on a global basis. We were seeing it in the NYSE, and we were seeing it in the percent of stocks trading above their 50-day moving averages. So what's happened over the last week? Well, after 2 weeks of sideways consolidation, we had some giant earnings reported by the biggest companies in the world. Apple was expected to have profit of 1.9 billion. They reported 10 billion. So revenues very strong, earnings very strong, and the stock certainly responded. Facebook, similar, under pressure politically, had been consolidating in about a $10 range from the beginning of May, reported very strong user numbers. The stock was up 10% the day they reported. Amazon had been consolidating through the previous month, had very strong earnings, exceedingly strong earnings, massive lift in the share price, although not back toward highs where we were in July at this point. So that's great, but let's look at what's going on underneath the surface. The world continues just to narrow a little bit. World breadth moved down a little over the course of the week. The percent of stocks and uptrends in the US moved down a little over the course of the week. You'll notice in Canada, in the US, and globally, all of them have the percent of stocks trading above their 50-day average, which is the intermediate trend indicator, has continued to decline, and meaning the markets continued to narrow. The percent of stocks with positive price momentum came down a little bit. Globally, we went from about 90% of stocks with upward trajectory to currently about 33% of stocks with upward trajectory. So what does that mean? It means you really have to target the leaders. It means you really cannot afford to sit in the laggards because they've been falling away. And we have to be vigilant for any sign that the leading stocks are starting to get hit. Now, that is not the case. And so it's all about targeting, not being in every group, but trying to target the leaders. So US breadth down a little, NASDAQ breadth down a little, world breadth down a little, percent of stocks above the 50-day moving average. Each of these have given back a little bit. So we're very vigilant, but at the same time, there are some wonderful stocks. A week ago, 47.17% of stocks globally were in uptrends. These groups in pink have shown some deterioration. A week later, not much change, 46.4% of stocks in uptrends, but markets higher. So it's all about targeting. So here's the things that we got over the course of the week. We're in the heart of earnings seasons. We've had 383 companies as of today report their earnings and their sales. Obviously, they're down. Sales growth is down about 11.4% on the quarter. Earnings growth down about 10%. Now, having said that, it's been much better than what was expected. If you looked at the estimates coming in, companies on average have beaten the revenue guidance by about 1.8%, and they've beaten their earnings estimates by about 22%. Now, part of that is the fact that companies haven't been giving any guidance. And so analysts probably sandbagged coming into the quarter with low expectations because they had so little information, and who can blame them? Now, what we do know, though, is that companies that beat the estimate, and this goes back over time, are responding, but not very much. The average company the day after an earnings beat is up 50 basis points, or about half of 1%. Apple, an obvious outlier. Amazon and Facebook, obvious outliers. If you missed estimates, the market's been punishing the average stock down 2.98% if you missed. So we're working our way through earnings, it's important to be in the right stocks. Other things we learned, obviously, GDP was down a ton in the second quarter, down 32% annualized. That's about what was expected. Some people thought it may be less, but that's where it came in. Jobless claims, which have been coming down since April, started to tick a little higher on some of the surge in COVID cases. But on the other hand, the leading indicators, the ISM data, started to show some improvement over the course of the month. And that's really what the market's focused on. It's looking forward and saying, what kind of trajectory can we expect? So that's a positive. And we are seeing that in various places. Germany also posted some pretty good forward-looking data. Investors, though, continue to be very cautious. We've now had a 23-week string, more bears than bulls. It's the longest since the data began in 1987. So this takes the investors' intelligence bulls minus the bears, and we're sitting at minus 30. So not very many bullish investors. People have sort of been dragged into this market kicking and screaming. So our job is to do three things, is to focus on market leadership. We don't have to be everywhere. Find the spots that are working, try to understand why, try to understand how long it could go on for, and focus on the leading companies to take advantage of that structural theme. Watch very closely for any sense of change, new leadership emerging, be prepared to make changes. And in the event that nothing's working, have an ability to play defense. Well, as it sits right now, there very clearly are some parts of the market that are working, and we're staying there. Over the course of the week, we continue to see a weaker US dollar versus world currencies. That's good for US businesses because it makes their products more competitive globally. And so some of the companies that benefit really benefited. This is the XLK ETF. It's the ETF that houses technology as a sector, large cap technology. And technology is a very ubiquitous term. There's all kinds of technologies that we're focused on, but these are the companies that are changing the world, and where the market is still sitting below the highs of February, this sector clearly outperforming. On a relative basis, steadily outperforming the market. Semiconductors would be a good example of that. Companies making computer chips, which are going into virtually every kind of device because so many things are becoming connected to the web. No sign of change here. Gold, we talked about this a week ago. We talked about this 7-year consolidation and the fact that we're coming out of it. This week we blasted above $2,000 an ounce, a new all-time high. Our premise is we are in an early stage new bull market, and that could be really profitable. So gold moved higher. The gold miners performed really strongly. The silver miners performed really strongly over the course of the week. This is not showing any sign of waning. And we talked last week about the fact that while gold is doing well, gold stocks have lagged gold for many years and are now showing the early signs of outperformance. So this could go on for a while. Basic materials companies have been really starting to lift. Now, we talked over the last while about the fact that commodities have been in a very long bear market, and we're starting to see some signs of life. The money supply being pushed into the system, ultimately good for hard assets. And the leading companies in the group often will have started doing well way before the group. So commodities put in a low in the bear market in 2015. We revisited lows for the commodity markets this year, but some of the leading companies never went anywhere near back to the lows, and this is Rio Tinto, which is a major holding of ours. This was a 5-year consolidation. Rio Tinto was in. The last time it broke out of a 5-year consolidation or after a bear market, stock went up 10 times over the course of the next number of years. So this is a company that we're quite interested in, pays a really great dividend. Medical devices companies continue to perform well, putting in new highs this week. Those are largely medical technology companies, and of course, internet retail and e-commerce. On the other side, the laggards continue to lag. This is the low vol, high dividend ETF in the US. These are people seeking income. And this was arguably way over-owned going into the decline. There are arguably some concerns about some companies' ability to pay their dividends. And this group is hitting a relative low. Now, this is something that we compare against in our income mandate because, of course, a lot of our holdings are dividend-paying equities. but this has been a tough place to be. Real estate investment trusts have continued to be very weak. Utilities have continued to be very weak. And on the other side, surprisingly, given the fact that those other sectors are bond proxies, bonds are quite strong. The 10 and 20-year bonds trading basically back at highs as of yesterday, new lows in yields in 10-year bonds, 5-year bonds, 2-year bonds, and 1-year bonds. Energy also has continued to underperform, and financial services. So if we take two different paths, the work from home group or the get back to work group, the work from home group continues to outperform, continues to be the place we are focused. So if we take all of the portfolios that we run and we composite where our weights are, understandably, technology continues to be very significant weight in the portfolio. Now, we bumped that up a little bit over the course of the week. We had taken technology down by 7 or 8%, taking some profits a couple of weeks ago when Breadth and the group reversed. We've taken our materials weight down just very slightly, but about the same. Healthcare comes in next at about 10%. Financials, which is not so much banks, but more fintech, comes in at 9%, consumer discretionary. So we're putting our money where our mouth is. These are where our focuses lie. We have very small holdings in these groups that have had weak returns. So what I wanted to do today is I wanted to focus a little bit on the equity strategies and just give you a sense for kind of where we're focusing, because they don't necessarily reflect exactly what the composite is. They're more growth oriented. We're a little bit more aggressive than sort of across all of the portfolios, which include income portfolios. So you can see that our major weight is technology at 31%, materials come in behind that at 29%. So if we break it into the smaller groups, gold is about 18%, and that's about as big as you could see us be. In technology, we're 17.5% software, sort of the most predictable part of technology because it's largely recurring revenue. Silver's about 6%. Healthcare and healthcare equipment about 5.5%. Consumer discretionary, internet, and direct marketing, retail 3.6%, copper, and so on. So the portfolio is really doing well. So far year to date, the equity pool is plus by about 21.7% versus the S&P up 6%. The Dow Industrial is down about 2%, the TSX down about 2%, and the World Index up about 3.4%. So this is all about targeting. What I wanted to do is have Brian come on and talk just a little bit about a few of the companies that he covers. We've talked a lot about some of the technology companies we've been in. Brian focuses a little bit more on Canada. But Brian, I thought maybe you could maybe highlight a few companies.
Yeah, definitely. So focusing on Canadian equities. So maybe I'll start with the gold, just given it is our largest subsector at around 17.8%. So within the mandate, we definitely have an equal split between small and large cap producers. Within large cap producers, our top pick currently is Kinross Gold, ticker is K. So Kinross's portfolio has experienced minimal impacts due to COVID. So they're actually been able to post production growth on a quarter over quarter basis, which definitely separates them from their peers. And this past quarter, they were able to put up record free cash flow numbers, more than doubling last year's results. And we should continue to see this trend into the back half of the year. Sorry, that's my dog. Continue to see this trend in the back half of the year just due to the rise in the movement in gold pricing. So, they really have a strong balance sheet. The balance sheet's going to get stronger. And one of the biggest catalysts that we can expect from Kinross is the initiation of a dividend. And we definitely see that on the horizon. Our top small cap pick within the portfolio is Equinox Gold. So really just a very strong organic growth story. They're on their way to becoming the next 1 million ounce per year gold producer. They operate in very friendly mining jurisdictions. And despite lots of capital required to help grow this production, they're still going to be expected to remain in a really strong free cash flow position. And that's just assuming gold price is $1,700. So there's definitely plenty of upside to this free cash flow number, given that we're above 2,000 now. So we have been actively building exposure to the smaller cap names just due to the increased level of free cash flow among their larger peers and what we believe will be a period of elevated M&A within the space.
So when you say M&A, you're expecting some mergers and acquisitions to take place as tends to happen in these kinds of cycles.
Definitely. I mean, if you're looking for, if you have a lot of capital to be sitting on, chances are you would have already announced a dividend. And, a lot of these smaller caps, single asset companies, they make for very friendly acquisition targets.
Right. Brian, why is it, maybe just talk a little bit about why when gold is moving higher, it is more productive to own gold producers than the gold itself?
Definitely. So, gold stocks play a different role than physical gold. I think a common misconception is that the two are sides of the same coin. And while they are positively correlated, there is a multiplier effect on the gold miners relative to the price of gold. So these miners have significant fixed operating costs and high operating leverage. So this means that when we see big swings in the physical gold prices, and we see a big swing in revenue, we're going to see an even larger swing in the operating income, and thus the overall stock price, seeing as they are priced off of earnings. So that's why we really love the miners in this environment.
And arguably, as prices go up, it doesn't just impact what they're producing, but it impacts the asset that they have in the ground,
yes,
which
exactly.
in many cases is years and years of production going forward. So it has a big impact. That's great. What else would you like to focus on?
So looking into technology. So two key themes within the portfolio definitely revolve around logistics and supply chain management, as well as e-commerce. So on my last appearance on this call, I spoke on two of our key names within the supply chain management industry. That's Kinaxis and Descartes. So just to recap on this theme, right now, managing supply chains has really never been harder. Corporations are facing increasing cost pressures, growing customer expectations, and disruptions such as COVID, as well as expanding ecosystems. So this all adds to what is already a very complex equation. And both Kinaxis and Descartes offer their own unique product offering that is ahead of their competition. And we should see them as structural winners emerging from COVID as larger corporations look to improve on their internal systems. We have Kinaxis reporting aftermarket today. It should be a really good quarter with a strong backlog, and they have a long sales cycle. So we'll see really strong revenue growth going into next year and even into the year after that as well. Excellent. And then within e-commerce, it's hard to not talk about Shopify, which has been the rock star in Canada during COVID. So really benefiting from trends of consumers looking at different avenues to purchase goods, as well as newer merchants looking to change how they run their business and become more flexible during this time. We saw this strength with their most recent quarter, which was reported last week. They were able to grow revenues by 97% year over year. They beat consensus revenues by 40% when their long-term average is about a 6% beat. And the number of merchants on their platform grew 70% from last quarter, which is just a crazy number. So that has been a very, very big winner for us. Two other names within the portfolio that have also benefited just from the rise in e-commerce are two of our industrial names, and that's Cargojet and TFI International. So Cargojet is the market leader in overnight air cargo shipments within Canada. They have a strong partnership with Amazon and will be growing with Amazon's presence within Canada. And TFI is a leading North American trucking company benefiting from higher volumes related to e-commerce. For TFI, we really like the environment that they're in right now. So they have the rise of e-commerce volumes coupled with the reopened trade when they're currently in what is one of the tightest trucking markets in recent history. So this should lead to very favorable pricing for them into the new year. So we see them as a structural winner as well.
Right. So these have clearly been two important themes. And to be clear, we do have lots of holdings beyond those. Descartes, obviously another big beneficiary within logistics, in the gaming, Activision, Blizzard in the US, in the move to 5G and in the cloud and machine learning. NVIDIA continues to gain market share. We've talked over the last year about solar and its increasing competitive position against carbon-based energy. And SolarEdge is the company that ties together, is by far the market leader, tying together all these solar panels in an efficient way to derive the most energy. From a fintech perspective, Square continues to win new market share with small and mid-sized businesses, and you can see that we do have quite a number of individual positions in the material space. One of the things we're trying to be very careful of is concentration, and that's a problem. I mean, yes, Amazon is a wonderful company. Yes, Apple is a wonderful company, but the reality is that they make up such big parts of the index there are risks that come along with those. So having a smattering of these ancillary companies that are benefiting from these themes really has been a benefit, because it helps us to manage kind of the risks associated. We've been really happy with how things are going on the equity side. Our equity long short pool is up just about 22%. Both of these are north of 22% today. Certainly versus the equity long short hedge universe is only up about 1%. The overall hedge universe is down about 1/3%, so very strong returns there. And the high income portfolio, for the fact that it's still negative on the year, down 4.9%, as of last week was about down 8%, so it's had a very good week, is really doing well relative to kind of the dividend paying indices globally. That's US, Canada, and international. So we're quite pleased with that. Balanced has done very, very well versus peers. The one portfolio that's been very tough has been our macro portfolio. We set that up to take advantage of what we think will be a summer correction as a hedge against the other portfolios. We'll see where that goes, but that's certainly set up as a long short portfolio, and so we'll go from there. Portfolios, I think, are well structured for this environment. We do have our fingers on the trigger. We do have stops in place on all of our positions. We look under the bed every morning to see what it is that we may be missing. But it is very hard to fight the flood of liquidity that has come into the capital markets globally. And you're seeing that in gold prices, you're seeing it in equity prices, you're seeing by the fact that we have record low yields. Central banks around the world are trying to encourage investors to take on some risk, provide some liquidity, so that the world's economic machine continues to move forward. And so long as these themes work their way higher, we want to sort of take advantage of them. If things should turn down, you can expect we will get quite cautious. We're into August now. We've got an election coming at us in November, so that's bound to become a little bit louder. We're about a week or two away from the end of the earnings period, so we'll have a little bit less corporate news in the marketplace. From a positive standpoint, we have lots of continuing information coming on therapeutics and vaccines, which do appear to be coming faster than many people expected. We do expect to continue to see stimulus get put into the system. And obviously, the US is in a bit of political battle right now between the Democrats and Republicans as to how they might do it. But both of them are committed to putting more stimulus into the system. So we keep going day by day, week by week. We continue to believe that the portfolios are well aligned with what's going on in the world. The US continues to be the most attractive place. US dollar is weakening, so we are hedged back to Canadian dollars to make sure that we don't give it back on the currency front. And we'll continue to update you as we go along. We certainly appreciate the fact that you are clients and that you've put your trust in us. We don't take it lightly. The team is working really hard. And with that, Pam, if there's any questions, maybe we could take those.
Thanks, Dave, and thanks, Brian, for joining. We're so lucky to have you as one of our key portfolio analysts. Always nice to see your face. No questions, Dave. I think, oh, wait, 1 second. Here we go. Okay, here's a question for you. If there is a down market over the summer, what would you expect gold to do?
Well, this is the nice thing, is that gold is a pretty productive asset in a difficult environment. And I think that part of the reason that people are putting gold in their portfolios is that they are looking for a hedge. And it's an asset that certainly can be a hedge against risk assets. It's benefiting from virtually everything that's going on. Money printing, certainly. We are getting lots of liquidity. And arguably, it's an asset that holds value against a depreciating paper currency. So we think that it can hang in well. But their stocks, if we started to see some weakness, we certainly can get a correction in these things. This bull market can go on a long time, but it will have corrections along the way.
Thanks, Dave. That concludes our questions for today. Oh, wait a minute.
Hey, Pam, I've got one thing I'd like to share.
Tell me.
I have one thing I'd like to share. like
Okay.
we're all focused on a lot of difficult stuff right now. We're all trying to work our way through this. I have a new friend that I just want to introduce everybody to.
Oh my gosh.
This is this is Friday. I got Friday on Sunday. Everybody can use a friend in the middle of COVID, and I am one of them. It's
So
funny how his eyebrows match my eyebrows.
Oh, Dave, when are we going to see him live?
I got him now. I've got him now. I might bring him on the call next week.
Come on. Yeah, maybe next week, bring him on the call. He's a welcome addition to the Barometer team. We'll
All right. Thanks everybody for logging in today.
Yeah, thank you, Dave. Thank you, Brian. Thanks, everyone. We'll see you next Wednesday with Friday.
Goodbye, everybody.